we have the wonderful Jesse Stamm, and Jesse was going like, "Why am I on? What am I doing in this call?" So, Jesse, you're unmuted, right?
I mean, yeah. No, it's just because I was going to be on, the Florida Turnpike coming down, and I was nervous
Yeah.
that if I'd make it in time. So, but I'm here. We're good.
No, you definitely make it because it's not till Thursday. So, we got some time.
So the lock-in's tomorrow.
Oh, you're going to a lock-in. That's fine. You can drive overnight. You're young enough. Um, so Mike and I have been talking, gosh, I mean, we talk all the time, but recently been talking about how FFL went from nothing to the largest IMO in the industry and what it was and then why we hit a plateau at some point in time. So how we got there, the Family First Life started December 12th, 2013. We became the largest IMO in the industry after 2.5 years. Like it wasn't long for us to take that number one spot. How we got there is we locked in. So the way we used to do this is there were mail houses that would drop mail, Jesse, and Sean would go to the mail houses, the big ones, and go, "Hey, we want to lock down every county you have in the country," which to a mail house is like, like I hit the lotto. Because that means every piece of data they get is getting sold. They have no more inventory. Like we took it all. But in order for us to do that, we had to take all the counties. So literally we had a draft, and every county in the country of the 50 states was taken. And you had agents there, great. If you didn't, so be it. I mean, I had counties all over the country. I'd jump on an airplane, fly and sell. The reason it worked is because we were locked into leads. The second reason it worked is because mortgage protection is the best lead you can buy to sell life insurance, period, end of story. I know everybody is selling the hell out of vet leads, which I'm happy for. Like, I love it. Congrats. It's great. Don't stop. My whole fear is in this industry, stuff changes constantly. So even while I was in the field running, I never just had my mortgage mailers. I had mortgage mailers with 4 different lead vendors. So sometimes I would get a $75 lead that the same person filled out with all 4 carriers. So that lead would cost me literally $300. Sometimes I would get none. Sometimes it was bad. Sometimes it was good. I also dropped final expense mail because that's what we ran, mortgage protection, final expense. I tried every lead you can imagine, but I never tied my income to one lead and one type of lead. One lead vendor, one type of lead. Okay. And I'm telling you all this because I don't trust Facebook. I watch what Mike does on a daily basis, generating leads. I watch my phone. I'm older, so the older you get, like you get up in the middle of the night, go to the bathroom. So I'll get up in the middle of the night, like 3:30 in the morning, look at my phone. Mike's still working at 2 a.m. Like we got to do this, we got to do this, and then at 7 in the morning, he's responding to text messages. And I'm like, dude, why are you up all night? He's like, because something's going on with the leads. Facebook did this, Facebook did that. Now we have that's a different topic for a different day. My point is, I'll be damned if I'm tying my entire income to a vet lead. Now I'm using them. Don't get it twisted. If you're using them, you're selling them, use them. Like don't stop. But I'm confused as to why we're not using mortgage protection. FFL was built on mortgage protection. Some final expense, a lot of mortgage protection. The premiums are high. You can use, by the way, I used IULs to sell mortgage protection non-stop. It was term CBO, final expense plans, IULs. It was everything we had. I sold a little bit of FEX, as a mortgage protection plan, a little bit of IUL as a mortgage protection plan, a little bit of straight term, a little bit of cashback term. I'm not even saying you have to do it, but guys, y'all should look at this lead. Jesse, I'm going to play this video. This is the ad that we run, or that Mike runs. And I want y'all to see how this makes so much sense.
Would you let someone steal your home? Here's the reality. If the main income earner in a family passes away, their loved ones might struggle to keep up with mortgage payments, putting their home at risk. But there's a way to prevent this. Mortgage insurance steps in to cover payments not only in the case of death, but also during critical illness, ensuring the family keeps their home. Protect what matters most. Click the link below, fill out a short form, and secure your home today.
That's pretty direct, don't you think? That's the
Yeah,
amount.
it's very direct.
Yeah, I've seen all the ads that are ran. It's like that is the most direct ad I've seen. It's like you die, your loved ones are going to struggle in the house. You want to protect that, click the link and someone will reach out to you and help you. Again, I'm not for me, it's like everybody thinks that we're in this lead deal. Like I could give two shits about the lead deal. I give a crap about agents making money. The reason Mike started doing what he's doing is because agents were getting ripped off by lead vendors, and the quality of the leads they were getting was whack, and the price they were paying was way whack. So Mike's like, I can do it better. I'm like, let's do it. And we fought that. Like I didn't ever want to do this because it's a pain in the butt. But I'm just letting y'all know. And Eric Schmidt, we have agents that run them now that are killing it, but it's just not enough. They're OTP, which means you fill out the form, you hit send, and then it sends your phone a text message with a code that you have to plug in for it to go through, which means the phone number's real. The biggest complaint, Jesse, that I hear is, oh, the numbers are bad. Well, hell, then why are you not buying all OTP leads? It makes no sense to me. So I want to go through and Jesse, why you're on here? Why are you on here? You're on here because I've heard in the past you say some stuff like older people kind of aren't my deal. They're harder to sell, and I'm not like that, which is fine because we all have our things. But I believe that if you understand just how simple this is, you'd be like,
Hmm.
real? Why am I not adding this in? Because at the end of the day, what killed us, Family First Life National in 2022, which feels like it was just yesterday, was mortgage rates went from 3.5% to 8%, and the mortgage mail completely dried up. So everybody that was comfortable dialing mortgage protection stopped selling insurance, basically, was crying about final expense, crying about internet leads. And I'm like, dude, I don't ever want that to happen again. So I'm not pushing mortgage protection to push. I'm pushing to go, hey, diversify what you're doing just in case something happens. Makes sense to sell IUL leads. Makes sense to sell vet leads. Makes sense to sell mortgage protection leads. Hell, it might even make sense sometimes to sell final expense leads. Have them all so that when times are good, you can pick and choose which one you want. Also have them all so that if something happens with any of the others, you have one or two to fall back on, and no matter what, your number is going to be hit. My number every week was $12,000 in issue paid premium. It had to be that, or else I couldn't run the business, my household, all of that stuff. So I was hesitant to do this call, Jesse, because we don't do the whole if you're not selling, you train, you don't train, which I'm completely good with. So I'm not going to sales train y'all. But I am going to give you some things that I used to do that I still know work because it doesn't change the fact that mortgage protection is mortgage protection. And a lot of agents don't know how to find the need in a mortgage protection appointment. So they just offer something that the client's never going to buy or don't even need. So for me, it was very simple because I owned a mortgage company, understood mortgages. I was very comfortable talking about the mortgage, and it gave me an edge over everybody else. Now, when I tell you I own a mortgage company, like it's not like I needed to know a whole bunch. Like I had a couple banks, a couple products, and I would help people with either a cash out refi or a rate reduction refi. It wasn't that complicated. So I'm not like some genius, but I just understood it. You could learn everything I learned on YouTube. YouTube University is fantastic. People don't use that enough. So I want to go through the 5 different mortgage protection clauses that you will use in a home. And all of this does, all you do is ask enough questions to figure out which category they're going to be in. And you can wish in one hand and shit in the other, see which one gets filled first. Most people don't. Most people say they want to pay their whole mortgage off, but at the end of the day, they know that old folks know that that's not really an option. Like they're not stupid. They're old. They've been around a lot longer than us. They know a lot more than we do. They're usually a lot smarter than we are too. So, um, and they're old. Like if you go a 7-year-old, we'll do it this way. Whose insurance cheaper on, Jesse, an 18-year-old or an 80-year-old?
And cheaper on 18-year-old
But and so why is that?
because they're younger. They're going to
They're
pay a
young.
lot longer, and they're probably not
So
going to die as quick.
okay, so do you think the client doesn't understand that they're getting closer to that? They're in the fourth quarter, depending, 50s, they're in the third quarter, 60s, they're in the third quarter, 70s, they're in the fourth quarter. Like it could be a 2-minute warning, it could be 2 seconds left. They're in the fourth quarter. So for me, that was always like, hey, there's a sense of urgency already built in. I don't need to push you. Like, I know, like, we don't have to say it out loud, but you're about to die. Like, can we just get real? So I want to go through this real quick. And I know Maurice is on here as well, and she writes a ton of mortgage protection insurance. So I'll call on her if I need her, because I do think, like, again, there is some justification to, if you're not selling, then you shouldn't be training. So again, I'm not going to give you all training, but I'm going to give you the 5 different scenarios that I used, and it worked the greatest. And for those that have been here for any period of time, Schmidt knows, like, I trained the entire company on mortgage protection. That was my deal. It made sense to me. It was simple to me. I could explain it very easily, so people loved it. And that's what Sean had me do at every conference for 9 years. In fact, I was like tired. I'm going like, dude, I do have other talents beside mortgage protection. Can I train on something else? He's like, no, why? You're the best at this. Let's just stay in your lane. So that being said, 5 different ways to close mortgage protection. Okay. And I want you to write these down, and I want you to study them. I have a long YouTube video on this stuff, and it was back from in the field days, but it's, again, it's still the same concept. The number one is you pay off your entire house, right? That's pay off your whole mortgage protection. That's number one. You can do that with the cashback option. You can do that in an IUL. My favorite way to do that was to give it to them for 25 years, give them the cashback option. And then after the 25 years, they take all of their cash and pay the house off 5 years early, save some money on interest. Everybody's happy. Client's happy. The mortgage company's happy. I'm happy. We're all good. Okay. But you can do a straight 15-year, 20-year, 30-year, depending on what their mortgage is. It's just paying off the entire balance. Number 2 is a partial payoff. And these are the terms I would use: full payoff, partial payoff. Number 2, where, it might be a husband and a wife, and they both work, make about the same amount of money, don't really have the money to buy full coverage. So they're going to put half of protection on in case something happens to either one. They can pay the house down, refinance, get the mortgage payment dropped to where both of them are comfortable. You can also do cash back on that option, or you can do an IUL on that option. This is not a product training. This is a concept training. That's number 2. Number 3 is your equity protection. Okay. This is where we get into the older folks. Okay. Jesse has a house. I'm going to go, Jesse, let me ask you a question. When you die, what do you want to have happen to this house? Jesse, you want to
muted.
answer?
Sorry. Yeah, I did. I'm muted. So for this house, I want my kids to get it.
You want your kids to get it. Okay. And Jesse, are your kids going to move into this house?
I mean, probably they would, or they might sell it. I guess I can't
Okay.
know for sure if they're going to move in or sell it.
Jesse, can I be honest with you?
Yeah.
Okay, nowadays, kids don't want their parents' houses, which is weird. Because, like, if I would have had the ability to have my parents' house before I bought my own, I'd be like, I'm in, right? It's a house. I grew up there, but it's just seemed to switch over the last 10 years, 10 to 15 years, where kids usually either sell the property or they use it as an investment property. Do you think your kids would either sell it or use it as an investment property?
I think they would probably actually use it as investment property. I don't know. I think they might use it as an investment property.
Okay, so now we're going to skip to number 3 or number 4, because number 3 is equity protection. Number 4 is transfer of assets. Okay. And this question goes either way. Jesse goes, they're going to use it as investment property. Now I'm in category number 4, transfer of assets. If he goes, they're going to sell it, equity protection. Okay. So let's just tell me they're going to sell it, and then we'll go down
Yeah,
that road.
they're selling that bad boy.
Perfect. Okay. So Jesse, obviously you were around in 2001, right? 2001. When houses were sitting on the market for 48 months, sometimes 3, 4,
Right.
5 years, and they couldn't sell. That's like
Yeah.
worst case scenario. I mean, obviously don't foresee that happening again. But what I like to do is give people the protection, so that if something does happen to, not if, when something happens to you and the market's not in a great condition, that your kids will have the money to make the mortgage payment on the house, maybe get it cleaned up, cleaned out, listed and sold at a decent price, so they don't have to do like a, buy cash now at this deal and take a lower price because we were mortgage broke. Make sense? Do your kids have
Hmm.
mortgage payments of their own?
Yeah, they both do.
And most folks can't afford their mortgage payment and another. Is that a safe statement?
Yeah, they'd have a problem with that.
Yeah. So what we're going to do is we're going to put in anywhere from 15 to 24 months of protection so that your kids again can get the house cleaned up, cleaned out, listed and sold, make that mortgage payment as long as it sits on the market. And so that equity and guys, in the beginning of this conversation, I should probably go back and go through it from the get-go, because in the beginning of the conversation, I'm asking Jesse, like, if you're going to sell your house today, what would you sell it for? Jesse says 400 and he owes 200,000. That's $200,000 in equity. Okay. And I go, okay, Jesse, if something happened to you and all your money in the bank just stayed at the bank, would you like that to happen? Like if you had $200,000 in a 401k and you died and your bank kept it, would that be good with you?
If the bank kept the money,
Yeah, your IRA company, if they just kept the money when you passed away, would you be good with that?
no, I want him to give it to one of my kids to get it.
Wanted to give it to one of your kids. Okay. So you probably, when you filled out that paperwork, you put a beneficiary on there so that when you
Yes.
die, they get the money, which is fine. It's kind of the same way with a house, Jesse. You owe 200,000. Your house is worth 400,000. There's $200,000 sitting there. And if the house, you can will the house to the kids, but actually the person that's got the first rights is the bank, because they have the deed of the property. They own it until the house is paid off. So if you not having protection is kind of like saying, hey, I don't care what happens to my 200,000 in my 401k when I die, the bank can take it. Chase Manhattan can take it, but my kids might not get it. Does that make sense to you? So we're going to
It
make sure that
does.
that $200,000 in equity is protected. God forbid something happens to you, your kids can't make the payments. We're going to make sure that they're good. Make sense? So
Hmm.
15 to 24 months, we're going to make sure they can do all that stuff. We'll be good to go. Okay. Again, concept, equity protection. 4 is transfer of assets. Jesse doesn't answer. They're going to sell the house. Jesse answers, they're going to use the house as an investment property, or they're going to move into the house, whatever it is. Okay, Jesse, you know how that works when you pass away and your kids want to take over that mortgage? Do you know how that process works?
No. How does that
Okay,
work?
fair enough. So it's like a purchase from the bank, and the purchase price is the balance of your loan. Make sense? So if you owe 100
Hmm.
grand, they owe 100 grand. If you owe 200 grand, they owe 200 grand. But they're going to pay transfer taxes and closing costs. Now, the transfer taxes aren't going to be on the sale price. It's going to be on the tax assessed price. So if your tax assessment is 300 grand, they're going to pay 6%, depending on what state you're in transfer taxes. And usually the seller and the buyer split the transfer taxes. But in this case, because the bank doesn't need to split the transfer taxes, in fact, they probably hope your kids just default on the property because they'll keep all of the equity. They're not going to split anything with them. So we're going to need to give your kids roughly 6% plus another 6% plus another 2 months of mortgages payments to make sure they have enough time to qualify for the loan, have enough cash to put down and get it closed so that they can turn around and rent that property. Does that make sense?
Hmm.
Okay. Guys, at any point in time, if you're not understanding me, please put a comment in the house. I mean, in the chat, so I can answer it, because this stuff will save your life with mortgage. Dude, any lead y'all are running, the financial inventory, you should be asking them if they have a house anyway. So we should be writing mortgage protection by default, because a lot of people that you talk to have a house and most of them don't have protection. Bain asked, I didn't understand the last part with the percentages. Okay. So when you buy a house, Bain, if I'm buying a house from Jesse and Jesse is selling the house for $200,000 in Maryland, I'm just because that's where I live. So we're going to say transfer taxes, meaning what the state's going to take for the sale of the house, the taxes is 6%. So on $200,000 house, it's 12%, right? It's $200,000 is 12%. I mean, sorry, $12,000 is 6% of transfer taxes. So on a $200,000 loan, I'm paying $12,000 in transfer taxes, which is 6%. I have to pay that when I close. The escrow company collects it, sends it off to the state. That satisfies my transfer taxes. In most real estate purchases, the buyer and the seller split the transfer taxes. But when someone passes away and I'm going to take over the mortgage, which means I need to refi it into my name, the bank's not going to split the transfer taxes with me. So they're going to make me pay the whole 6% in Maryland. So I do 6% for the transfer taxes, another 5 or 6% for closing costs, and a few months worth of mortgage payments in case it takes longer than 30 days for them to close on that loan. Does that make sense? So on a $200,000 mortgage, I might do a $30,000 whole life policy. So they can cover the 6 months of transfer tax, or the 6% transfer taxes, which is 12,000, the closing costs, escrows, all that stuff, which is another 12,000, and then they're going to have another $6,000 to make mortgage payments for the next 2, 3, 4 months. Or God forbid they come in FHA. There's so many little caveats to this, which is why y'all should do a little research on mortgages. But if they do an FHA loan, let's just say Jesse's kids are just getting started, they just bought their house, they can't afford, they buy a house with an FHA loan, then there has to be an FHA inspection. If the FHA inspector comes in and something's wrong, they have to get it fixed before it can close. So that cash is just going to give them the money that they need to do what needs to be done to close the loan into their name so they don't lose the equity. That's simple. Makes sense, Jesse?
Yep.
Okay. Do you have any questions?
No, that makes total sense. I understand.
Okay, perfect. So that's number 4. Number 5 is the reverse mortgage protection. This by far was my favorite way to close mortgage protection when they were older folks. Jesse's married and wants to make sure when he dies that his wife can stay in the home because she didn't work as much as he did. She raised the kids. When he dies, she's going to get the higher the 2 social securities and half his pension, maybe none of his pension. And so the question I would ask Jesse is, Jesse, let me ask you a question. How much do you own the house?
Um, on the 200,000, I have I guess it's like 89, 90,000.
90,000?
Yep.
Okay. And how much is the house worth?
Um, Probably 300,000. I can probably get about 300 for it.
So they owe 189 and it's worth 300.
No, 89 and it's worth
80.
300.
Okay. So then I would do a transfer of assets plan on this one as well. The reverse mortgage, there's got to be a little closer gap. So the house might be worth 300. They might owe 200. Make sense?
Mm,
So
okay.
anything under that, it's
Why
a
is that?
transfer.
Why is
Because
that, Frank?
you only need 50% equity to do a reverse mortgage. So if your house is worth 300 and you owe under 150,000, you could do a reverse mortgage with no cash down. But if the house is worth 300 and they owe 200,000, they need $50,000 cash to close that reverse mortgage. Okay?
Mm,
So, let's just say in this scenario, 300,000 is what the house is worth, the balance is 200,000. I'd go and first you got to do when you got to preface these appointments with, Jesse, what do you know about reverse mortgages? Because people have bad information on how reverse mortgages work.
I don't know anything about it.
Don't know anything. Okay, so let me explain to you how they work. Essentially, the bank's going to say, we're going to give you a loan for 150,000. Your house is worth 300. You can have $150,000 reverse mortgage. Cool thing is, if you owed nothing, they give you $150,000 cash. They defer that payment till the day you die. So let's just say, for easy purposes, house is worth 200. You got $100,000 reverse mortgage. They're going to charge you 5% a year, which is $5,000. Make sense? So every
Hmm.
year, the balance of your mortgage goes from 100,000 to 105,000 to 110,000 to 115,000, 120, 125, and so forth. When you die, that's when that number becomes due. Wherever you die at, if it's 125,000 or 135,000, that's when that number is due. The cool thing, Jesse, is that the mortgage company is going to give your family 12 months to figure out what they want to do with the house. So it's got a built-in equity protection already, because you do have equity. Like, banks don't do this to lose money, obviously, which is why you have to be a certain age and you have to have so much equity, because they can't afford to allow you to owe more money than what the house is worth. They would go under, right? It makes no sense. So what we're going to do, Jesse, you owe 300. I mean, you owe 200. Your house is worth 300. In order for your wife to live here payment free, she needs $50,000. So Jesse, can we agree that it's not necessarily the balance of the loan, it's the monthly payment attached to it that is the issue, correct?
Hmm.
So if
Hmm.
you owe $2 million on this house, but the payment was 29 cents a month, would I be talking to you right now?
No,
No.
it's the
So
payment.
it's not the balance, it's the payment. If I can eliminate that payment, would that make you feel secure that your wife could stay here till the day she dies?
Absolutely. That'll make a big difference.
Perfect. I'm gonna do a $50,000 term product. I'm gonna might stack 2 whole life policies. I'm gonna give him enough coverage so that when he dies, she can put that money down on the mortgage, reverse it, live their payment free till the day she dies. Very, very simple. That changed my world because when I was doing this in the beginning, I was like Jesse. I was like everyone of y'all that go, old people suck to sell insurance to. Can't sell mortgage protection to old people. I was the same way. And then finally I was like, this sucks. What can I do? And I sat in a home and got through something in my head. The numbers worked out right. I'm like, well, hell, they only need 30 grand to qualify for reverse mortgage. Let me see if I can make something like this work. And it worked out. The guy was happy as could be. The coolest thing was he was 78 years old. It was like a $300 a month premium. And he still pays it to this day. Those don't cancel. And here's why. Like I've seen y'all pitch mortgage, which and it's fine however you want to pitch it. I've seen you go, we're going to give you 12 months of protection. We're going to give you 6 months of protection. Well, what the hell does that do? After 6 months, I call that Band-Aid protection. So whenever I would go in a home and somebody like, yeah, I just met with somebody last week. I'm like, well, what'd they do? Well, they said they gave me 12 months of payments. I'm like, so what happens if 2010 happened again, where houses were sitting on the market for 3 years? What happens after that 12 months? You know what I call that, Jesse? I call that Band-Aid protection. Let me give you an actual plan so that when you die, we know exactly what your kids need to do or your wife needs to do so that she can keep the house or do whatever she wants to do with it. Is that fair?
Hmm.
Guys, this is the simplest close in the world. Number 6 is reverse mortgage protection. So getting out of a reverse mortgage. Okay. And this works. And again, none of these work 100% of the time, but they'll work 90% of the time. Sometimes they're just in a good situation. So if Jesse's already in a reverse mortgage and when he dies, he wants his kids to have the house and they want to move in, then I'm essentially going back to, hey, transfer of assets because they have reverse mortgage. They're going to need to buy the house back from the bank. It works a little bit differently. They're going to pay off a little more than what you owe now. So we need to overestimate what you think it might be. But we need to give them enough to buy the house back from the reverse mortgage company, which they should be able to do. It shouldn't be a problem, but they got to do it within 12 months. So sometimes we give them a little more time if they have guys. My deal was asking a million questions. I asked questions about their spouse, about their kids, what their kids do, how long they've been moving on their own, if they own a house, if they rent a house, when the last time they renewed their rent was. Because if Jesse just moved into an apartment, I know he signed a 12-month lease at least. Like not 99% of the time, I know he signed a 12-month lease. So like he goes, well, my son can handle it. Okay, he just signed a 12-month lease. So if he can pay your mortgage and pay his rent, that's fantastic. But you already told me it'd be tough. So he's going to have to pick the mortgage or the rent. And if he doesn't pay the rent, he's going to get a huge penalty. He's going to owe that money back anyway. So we're going to put this in place so he can do both till he gets out of that lease. Like you ask enough questions, dude, this people will sell this for you. You just got to listen. So get really good at asking questions and you can close 80-year-olds, 85-year-olds, and you can have bigger premiums that actually make sense. So when I would tell them, I go, if I closed them on 1, 2, 3, 4, 5, or 6, I would write it out. Like, here is the name of the plan we did for you. So if some other fool comes in behind me, he's not going to know what he's talking about. When Jesse goes, no, I got a transfer of assets plan. Like they're going to go, what does that mean? Oh, the fact that you don't know, I don't want to talk to you. Like I gave them so much comfort in knowing that we have an absolute solution to their problem. They're not going to have to worry about it again. And they didn't. So does that make sense to you, Jesse?
It does. It does. But I have a question as me.
Yes, please fire away.
Okay. Okay. So I think my biggest hesitation has been in the past is when it's the 78-year-old with diabetes and heart disease who says, they want to pay off their mortgage and they owe 300,000 and they
Hmm.
come in guns a blazing with that. And it feels like that's already in their mind. So I was talking to actually Mike about this the other day, like, okay, I think that the challenge is, or not the opportunity, I guess, is how do you convert that person's thinking before you're in the defensive of, girl, you crazy? Like, how do you get it to, like, because that's
Yeah,
psychotic, right? I mean, like, I'm
I got
900
you.
years old, I'm really sick, and I'm going to get $1 million for 3 pennies. So you can hear in my words, that's what I'm thinking they're thinking.
Yep.
So how do I get them
So,
out of that?
so and some people you're just not going to help, right? So get
Yeah.
that out there, right? But Jesse, you owe 300,000. How much is the house worth? If they're 78 and they just refinanced again, like they're idiots, with all due respect. Like you should not be
Okay.
78 having to refinance. Now I get it. I get it. There are situations that happen, and sometimes people need to do this for medications. Like, got it. But if you're a normal person, then that's foolish. How much is a house worth of 300 grand? Is it worth 350? Is it worth 325? How much is it worth?
I would say in that scenario, which everyone comes up with scenarios that are super rare and never happen. That this is a seems like kind of a chunk of them. It's normally they've only had it for a couple years, so they
Couple
usually
years.
get 325, 350. It would be very
Okay.
realistic.
So here's what I always did in every home. When I would get in there, I'd ask the questions and I would go, so how much is the house worth? Well, I just did this a few
Mhm.
years ago. It might be worth 325, 350. I look it up on Zillow, kind of confirmed. I go, okay, let me ask you a question, Jesse. If I walked out of here and left $25,000 laying on the table, would you take it?
Sure,
Do you think that would change your kids' lives or at least help them out a little bit?
I'm sure.
Okay. So so is it okay if I'm very honest with you?
Yes.
Okay. So you're in your 70s, you're diabetic, which diabetes makes it tough to get insurance anyway, because once the effects of diabetes start going bad, you can't reverse it. And I don't know if your doctors told you that, but they should have. So like if you start getting neuropathy, things like you can't reverse that effect. So insurance companies are very skeptical or cautious when it comes to diabetes. So paying the house off is a little bit crazy in the sense of how much it might cost you on a monthly basis. But can we agree whether you give your kids a house that's paid off or you were able to give them 25 to $50,000, that would still help them out tremendously. Is that a safe statement?
Yeah.
Because you wouldn't want again, you wouldn't want, like, if you had $30,000 in the bank and you passed away, would you be okay if the bank kept that money?
No, I don't want the bank keeping any of my money.
Correct. So your house works the same way. If you don't have some protection in place and you pass away and your kids can't make that mortgage payment, and with enough time to sell it or buy it back, the bank's just going to take the house and the money that comes with it. In fact, Jesse, they're hoping that you don't because they make money on those deals. Hell,
Mhm.
it's like payday for them. So my job is to make sure that when you pass, your kids at least have the ability to either purchase the house back from the bank or sell it and get that money that should go to them rightfully. That's how I switch it. I don't care how much money
Yep.
it is.
Okay.
Like it could be two thousand
That makes
dollars.
sense.
If I left $2,000 laying on the table, would you not pick it up? Like, stop, right? So it's all perspective. We get into this world of monopoly money with Family First Life, and it's not 100 grand. It's like, hell, dude, give me $1,000. I'll take it. I still get mad when I lose $1,000 on a basketball game. I'm probably gonna lose $1,000 a night because I hate this game. I lost 1,000. I lost 4,000 on Saturday. It's a lot of money. So my goal is to just get them to stop being so over the top unrealistic and just bring them back to reality softly. And again, if they're a jerk, they're a jerk. I mean, it is what it is. But if you can switch
Right.
that
Right.
a little bit, then most of them will at least hear what you have to say, which means you have a better chance of closing it. Because when you put it that way, $25,000 is a lot of money. Cover student
Yeah.
loan debt, cover a down payment on a house, can cover credit card debt, car payment. Like, dude, that's a lot of money. Can we just stop with
Well,
it's not the whole thing?
I guess in most cases, it's really actually the equity protection or the transfer that's actually going to be the issue that they're being short-sighted of. and it's getting them to get there, but in a more controlled way versus what I'm hearing versus handling their insanity head on. It's more like helping them come to a reality um, that takes a little bit more time versus kind of asking them in the beginning, oh, what were you looking for? And then they say, oh, $400,000, and it's just, that's not
And
happening.
immediately go, for what? What is that for, Jesse?
To pay off the house.
Okay. And who's going to move in when you die?
I'm gonna leave it to my kids.
What are they going to do with it?
They're probably gonna sell the house. No, I hear what you're
You know what I
saying, and
mean?
it
Like,
makes
it's
sense.
just, I just
Yeah, I'm
keep
not
asking
asking.
questions.
Yeah. That's a great point.
And most of us don't ask enough questions. That to me made my job so much easier because whether y'all believe it or not, everybody always goes like, "You must be a great salesman. You're probably really pushy." I'm like, I'm the opposite of pushy. I want the least amount of pushback as possible when I'm going to close a deal. I don't want to have to push you. I want you to go, this makes sense to me. How can I move forward? And when the only way for me to do that was to ask so many questions that I got enough ammunition to when they fired at me, I could just blow them away. You know what I mean? So I
Mhm.
do want to get, let me see if Maurice is on here. She is. I'm gonna
It's the
Maurice, I want to unmute
opportunity
you
then.
because
Say no. We did not.
Maurice, are you there? I just unmuted you. Is she on she might be closing.
Hey, how
Are
are
you
you?
closing your
Yes,
deal?
sorry, I was on a call.
That's
I
fine.
was about to take a call, rather.
I want I know how you close a ton of mortgage protection. And again,
Yes.
I want these folks, I don't want these folks thinking I'm trying to push mortgage protection because I'm just trying to get people to diversify. Because again, what I do know is FFL was the largest IMO in the industry. We hit a cap when we couldn't produce any more mortgage leads. Now they're unlimited, and it's the best annuity lead you can buy, by the way. I found ask Dean how many of his annuities come from mortgage protection, and he'll tell you all of them. So, can you just talk a little bit about what you do on a weekly basis with mortgage and just how simple it is to close? And I don't care if you use the 6 steps. I don't care how you do it because you do it very well. I wanted somebody that's actually selling to talk because this goes against what FFL does. So, at least I could.
Absolutely. And I think that mortgage protection is a huge way that not a lot of us are getting in front of. To be honest, I think some of us want like that quick, easy close, for lack of a better term. And nothing wrong with vet leads, guys, but just like how Frank opened the call saying, when you can diversify your lead flow, that's everything. There's so much truth to that. Really, what I mean when I'm saying that, it's like you're not tied to, oh, well, you know what, the ad that's running, I don't like it, I want to insert excuse. Like at that point, like when you diversify your lead flow, you're just so much stronger in so many different areas. Just like how I have veteran leads on and I'm trying to do IULs and getting Jesse's help in the process. We're all helping each other to help each other. But what you have to realize about mortgage protection is it's something that somebody already has. And one thing that human beings are we all have it embedded in us is fear of loss. Period. End of story. If somebody just got a house, or better yet, they had a house for over 30 years, do you think that they're willing to lose it? Or what aren't they willing to give to not lose that house? So when you can realize this person actually has a problem, guys, there's actually debt. Just like when everybody dies, there's a final expense bill that has to be paid. There's actually a bill that's going to need to be paid, and their family is going to be faced with it, period, end of story, at a higher scale. If you think that that is not a slam dunk close, you're all of us running mortgage protection. I love you guys, but we're playing you guys because like we're out there like, yo, this is the slam dunk easy close. They need this just like they need to be buried, just like we all a little bit less than that, because there's still that huge fear of loss. And that fear of loss and selfishness will sometimes overtake it. And that alone will allow you to have easier closes. So don't sit there and convince yourself, I can't work mortgage protection. I don't understand it. I have to know all these fancy concepts. Nope, you have to know if they're healthy, show them a full or a partial payoff. And maybe, Frank, about 10% of the time, there's a full payoff happening. Very, very rare case. Very, very rare case. That's a high percentage, guys. Maybe the other 40% is a partial payoff, and the other 50% are the last, 4 concepts that Frankie talked about that equity rescue or critical period where you're buying them, that 12 to 24 months that Frankie's talking about, the transfer of assets, that's the stuff that can sound complicated, that's not. It's the same way I make an annuity complicated, guys, okay? Y'all tell me it's not. I've written a few. I know it's not that complicated, but guys, it's the same thing. So if you're not out there writing mortgage protection, you're simply leaving money on the table for everybody else. So sell off of concepts and it's all going to make sense. Just tie it into your lead flow. A little blend of everything's always good. Thanks, Frankie.
Thank you, Marisa. I appreciate you, honey.
Of course.
All right,
Appreciate
y'all.
you.
And y'all saw the ad. Like, it doesn't get any more direct than that. Like, it's the most direct ad that we have. If people go, I don't know why you're calling, they're lying to you, which is very possible because people would fill out a form, put their name, their address, if they smoked or not, and they'd say, I didn't do that. So I'm not going to say they're not going to lie to you, but hell, it's very direct. So, guys, I hope this helps. I really do. I think we're leaving room for so much more growth on the table just by avoiding this because it might be a little bit uncomfortable. But if you get it down, you'll be able to do this for the rest of your career and you'll be able to build a massive team that can do the same thing because we're not relying on mail anymore. We can generate these leads on YouTube, on Facebook, on Instagram, on TikTok, and there's never going to be a shortage of people that own houses. It doesn't just target people that just refinance or just purchase a house. It just targets homeowners. And everybody and anybody could benefit from having a plan like this. So, Jesse, thank you so much for playing along with me tonight. I appreciate you. I apologize if I left you in the dark a little bit. I kind of wanted to. Um, but guys, this is simple stuff. Marisa is one of the best. If you have any questions, reach out to her. Jana, Dean, they're all incredible mortgage protection closers. This is something that you should implement in your business immediately. If you want to start writing more business at higher premiums, good persistency and annuities, it's a good way to go. So thank y'all. Have a great night. Appreciate you guys. Jesse, Marisa, thank you. Love y'all. Take care.